Welcome to The Explainer. Today, we're diving into something absolutely crucial, demystifying business finance. Whether you're an aspiring entrepreneur, an investor, or honestly just someone who wants to understand how money actually flows through the corporate world, you are in exactly the right place. We're going to strip away all that complex jargon and give you the foundational tools you need to read a business like an open book.
Imagine this for a second. What if you bought a whole company, poured your hard-earned money into a brand new venture, but you literally had no idea if it actually made money? Imagine having no clue how much cash it had in the bank right now, or completely guessing at how much debt it was dragging around. No way, right? It sounds like an absolute nightmare. It's basically flying blind, and in business, flying blind is a guaranteed one-way ticket to failure. The risks are just massive. Well, that is exactly why financial statements exist. You can think of these documents as a comprehensive health report for a business. I mean, a doctor wouldn't just guess your diagnosis without checking your vitals, right? So an investor or a business owner shouldn't make moves without checking these numbers. They reveal, clear as day, whether a company is actually thriving and healthy or secretly struggling behind the scenes.
Okay, let's dive into this. We have a very clear roadmap for our explainer today. First, the income statement. 2, the balance sheet. 3, the cash flow statement. 4, a quick real-world coffee shop example. And finally, bringing it all together into one complete picture.
All right, part 1, the income statement.
So let's start with the absolute most common question anyone asks about a business. Did it make money? To figure that out, we turn to the income statement. Simply put, it's a report showing whether a business made a net profit. And the really crucial thing to remember here is that it measures this over a specific window of time, say a month, a quarter, or a year. It tracks exactly what came in, which we call revenue, and then it subtracts exactly what went out to keep the lights on, the expenses. And whatever is left at the very bottom, that's your net profit. It is essentially the ultimate scorecard for a company's past performance. The math here is actually incredibly simple. Let's say we start with the revenue, $100,000 earned from sales. From that, we literally just subtract our expenses, the $75,000 for things like salaries, rent, marketing, taxes, the whole shebang. The difference leaves us with our net profit of $25,000. So this statement instantly answers our first big question. Yes, over this specific period, this business definitely made money.
Moving right along to part 2, the balance sheet.
Now, making money over a period of time is great, but it's really only part of the story. That's why we need to shift our focus a bit. We're no longer looking at how the company performed over the last year. We want to know where it stands right this very second. Unlike the income statement's time window, the balance sheet reveals the company's true financial position on one specific day. Think of it like a freeze-frame photograph. It shows exactly what a business owns, which we call assets. It shows exactly what the business owes to others, which we call liabilities. And finally, it shows the equity, which is just the owner's share of the business after all those debts are paid. This entire document is anchored by one unbreakable golden rule: assets equals liabilities plus equity. You can see that golden formula perfectly in action right here. Look at the total assets, that entire $500,000. Well, that didn't just magically appear out of thin air, right? It had to be funded, and we can clearly see how. It's split between $200,000 in liabilities or debt and the remaining $300,000 in owner's equity. Everything the company has is balanced perfectly against how it was paid for. And that tells you instantly just how financially strong and stable the business actually is today.
Okay, part 3, the cash flow statement.
So we know if it made a profit and we know its overall financial strength. Now we need to look at where the cash is actually going. And I really need to drop a vital hint here. A profit on paper absolutely does not mean you have cash in the bank. To really grasp this, we have to look at these two concepts side by side. Profit is usually recorded the exact moment a sale is made. So say you sign a huge contract today. Bam, your income statement gets a massive boost in profit immediately. But cash? Cash only matters when the actual physical payment hits your bank account, which honestly might be weeks or even months later. This massive disconnect is exactly why the cash flow statement exists. It strips away all the accounting magic and tracks pure liquidity, the actual hard money moving in and out of the door. On this statement, you'll see cash coming from 3 main sources. First up, operating activities, that's the day-to-day running of the business. Second, investing activities, things like buying or selling big equipment. And third, financing activities, like taking out a bank loan or paying dividends. The big takeaway here? Maintaining positive cash flow is literally what keeps the lights on, because you definitely can't pay your employees with paper profit. You can only pay them with cash.
Let's put this into perspective. Part 4, the coffee shop example. All right, let's see how this all builds in real life. We've talked theory, but to truly understand how these three statements work together as a team, let's zoom out and look at a hypothetical local coffee shop for this month. Looking at their income statement, things seem fantastic. They brought in $20,000 in revenue. Their expenses, coffee beans, paper cups, the usual, came to $15,000. Subtract those, and you get a very healthy profit of $5,000. If you only looked at this income statement, you'd probably confidently say, wow, this business is highly successful.
But here comes the brutal twist. Let's compare that income statement reality to the actual cash flow reality. Yes, they are profitable by $5,000, but wait, a massive chunk of that revenue came from catering a big corporate event. And guess what? That corporate client paid using an invoice that isn't due until next month. The actual cash hasn't arrived yet. Meanwhile, the coffee shop landlord is literally standing at the door because rent is due today. So the business is profitable on paper, sure, but it is effectively broke in reality. It's completely short on cash and in immediate danger of eviction.
Which brings us to our final section, Part 5, One Complete Picture.
That terrifying coffee shop scenario perfectly highlights why relying on just one single financial statement gives you a super dangerous blind spot. Whenever you analyze a business from now on, you always need to ask these three distinct questions to get the full story. Number 1. Is it profitable? To answer that, you pull up the income statement. Number 2, is it financially healthy overall? For that, you check the snapshot of the balance sheet. And number 3, does it actually have enough cash to survive? That is where you demand to see the cash flow statement. If you can answer all three of these plain English questions, you're not a beginner anymore. You are actively thinking like a seasoned investor.
3 reports, one complete picture of a business. Financial statements might look incredibly complicated and intimidating when you first glance at them. But once you understand the simple purpose behind each one, they transform into the most powerful analytical tools in the entire business world. So I want to leave you with a final thought to chew on. Next time you hear a company boasting about record-breaking profits on the news, what's the very first question you're going to ask about their actual cash? Keep exploring, keep questioning, and I'll see you in the next explainer.